Good evening, everyone. Time for another silver update. This is a 30-minute chart of silver provided by netdania.com. You can click on the link below. Drawn a couple of key lines here. One is the descending trend line, and you can see that the line is meeting up at about 33 bucks on the silver price, and you can see we're in the process of correcting through time. Now, correction through time is when the trend line is met just by sideways action. So if this trend line is going to continue, then we're either going to round down and go a lot lower before we meet this line, or we're going to meet this line and then fall. So the other line here is the support line that was touched, briefly breached, and then we rallied from. And that's going to be around 32.60 or so. So those are going to be some key price points. Now, of course, when we see significant price declines in the silver, especially very drastic moves like this and then confirmation moves, we're ultimately looking for some type of bottom formation, but really we're looking for stacking opportunities. So it's one of those things where if you are a person who is thoroughly convinced about the fundamental story, then a declining price is always going to be good news to you. One, because you have that much more opportunity to stack at a lower price, and two, because a lot of people have not really been able to get on board, so to speak. So it's another opportunity for newer people to increase their stack. And of course, when all is said and done, when the whole game of musical chairs is over, ultimately it's just going to be how big is your stack. We're not going to be talking about dollar prices. We're probably not even going to be talking about dollars at all, because probably the dollar is going to go the way of the dodo bird. So we're going to be talking about some other currency or some other economic system, and how big is your stack, and then how can you convert that. So the big game is going to be stacking. Now, I'm really encouraged by the comments and the forum threads and the blog comments and the YouTube feedback that I get. Believe it or not, during this smackdown that occurred on the 29th, which was an enormous 10% move. Now, just to give you an idea of the size of this move, you can imagine that if the Dow, which is flirting with 13,000 or so for the last recent time, you can imagine that if the Dow fell 1,300 points in the span of an hour, you would expect there to be a lot of questions asked. People would be demanding explanations, and it wouldn't suffice to say that Bernanke didn't mention QE3 again, therefore the stock market fell 10% in the space of an hour. So that ought to give you pause when you're thinking about this market, and you should realize that this is not a normal market. This is not a typical type of market when we're talking about this type of volatility. Now, when we have this type of volatility, fortunately we have silver sites, and I'm going to go to one here after this, that do actually tie their prices to this volatility. So you can take advantage of this type of price movement and lock in a low price. But these types of price movements have a purpose, and I want to explore that a little bit here. The thing you need to understand about the futures market, and we've already covered in the last series of videos, if you remember, we did a video on the bullion banks, and we also did a video on the derivatives, and we did a video on this volume. And if you recall, when you read articles recently in the investment community about silver and why silver is a risky, dangerous asset, they always cite these types of volatility spikes. Now, these types of volatility moves serve two purposes. The first purpose they serve is, of course, to discourage investment in silver. And that's ultimately going to be the reason why these derivative traders, because as you remember I pointed out last night that we're looking at a tail wagging the dog situation. We're looking at anywhere from 260 to 1 to 150 to 1 derivatives setting the price for the underlying. So the tail is wagging the dog. The tail is these ridiculous oversized paper positions, and the dog is going to be the silver itself. But one of the key reasons you have this tail wagging the dog situation is for them to create this massive volatility so that when investors call their investment advisor, they call their certified financial planner, they call all of these representatives of the system who teach the dum-dums and the sheeples of the world what they should do with their money, they can say to them honestly, well, silver's a very risky investment because it tends to move in these enormous percentage moves. And if you went and took $100,000 of your money and bought silver right here, well, you'd have a 10% loss right here an hour later. So I don't advise that you invest too much of your money into silver because it's just too volatile of a investment for you to feel comfortable in. So that's the number one reason why they create this volatility with their tail wagging the dog, derivative running the physical scenario. That's the first reason. The second reason, and we're going to get into this when we take a peek at the sovereign wealth funds, is that the nature of the debt for this paper contract, which really isn't extreme amounts of leverage. If you remember, when we looked at the leverage that's required in the silver market with the recent margin increases, and if you remember, back in the May SmackDown, we had a consecutive 6 or 7 margin increases that were piled on to this that helped create this crash-like scenario. But the cost of carrying silver as far as putting up the margin is going to be about a 7-to-1 ratio. We're bouncing around that 15% range, and then the maintenance margin is going to be less. So you're looking at about 7-to-1 leverage at 15%, which means that basically if you risk $100,000 and you're fully leveraged and they do one of these moves against you, you actually could be having to pony up a lot of money. So that's the second reason why they cause these violent, dramatic price moves in the price of silver, is that they are deadly afraid of any type of serious wealth coming in and taking a position and standing for delivery. Now, standing for delivery is essentially putting up 100% of the value, but if you're a person who's trying to build that over time or take a larger position, then obviously you're not going to go into your futures account and deposit. Let's say you want to carry one contract of silver, which is 5,000 ounces, so 5,000 ounces times $35. You do the math. That's $150 to $200,000. Now you're not going to walk immediately in to your brokerage and deposit $150,000 to $200,000 for each contract of silver. You're probably going to be somewhat leveraged, and if you have to, you're going to pony up the difference. Now, when you have these tremendous outlier moves like this move and this move and this move, then you could have a very, very rapid margin call on your money, and it makes it a lot more difficult to stand for delivery when you have this type of violent up and down price movement. So those are the two primary reasons why they create this excess volatility. I've covered before the fact that there's nothing inherent about the silver manufacturing process. There's nothing inherent about the silver mining process. There's nothing inherent about the smelting or the stamping or the issuance of collector coins. There's nothing that's inherently volatile about anything about silver. This volatility is simply tail wagging the dog situations where the manipulators are intentionally moving the price in dramatic ways very rapidly so that they can A, discourage individual investors from investing in silver, and B, discourage large buyers from standing for delivery. Now, I wanted to talk about some of these large buyers, talk about some of the potential money that we're talking about here. Now, this is an article on Wikipedia. It's just a generic, plain old vanilla article on sovereign wealth funds. And so I'm going to read a brief definition and take a look at these funds. A sovereign wealth fund, SWF, is a state-owned investment fund composed of financial assets such as stocks, bonds, property, precious metals, or other financial instruments. Sovereign wealth funds invest globally. Most sovereign wealth funds are funded by foreign exchange assets. So these are primarily the Forex, the positive Forex accounts that countries that trade with other countries accumulate when they have a trade surplus. So that's not exclusively the case, but generally that describes the vast majority of sovereign wealth funds. So these are countries that have an asset, and when we get down to this list here, you can see the asset is listed. It goes oil, 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 non-commodity. But these are government funds or quasi-government funds that are searching the world for a safe home for their investment. And generally, they've accumulated dollars. That's not universally the case, but because of the petrodollar system that we're currently on, the world is flooded with US dollars. To a certain extent, it's flooded with euros and some other currencies, but primarily the world is flooded with US dollars. Now, if you go down to this list here of the sovereign wealth funds, the first thing that stands out when you look at the largest sovereign wealth funds in the world is that the United States is not even in the top 10. In fact, the United States just barely scrapes in at 19, with the Alaska Permanent Fund at $39 billion. And other than that, the United States doesn't enter in until we get way, way down to the New Mexico State Investment Trust, and then there's a Texas Trust, etc. So you can see that the United States isn't even in the running. So let's look at the big dogs in this game here. We've got the Arabs with the top one, the UAE and Abu Dhabi at $627 billion of primarily oil revenues they've accumulated. Then, of course, number 2 is China, but number 5 and number 7 are China, and number 8 and number 9 are Singapore. So Asia has a huge representation here. Norway is coming in here at number 3, and that's pretty much it. You have Canada sneaking in here around 10. Russia gets a fund in here, and then Australia, Libya, which of course they stole all that money. We'll see if that ever goes back, and Algeria. So primarily we're looking at the Asians and the Arabs and a couple of maybe 1 or 2 Europeans and Canadians thrown in. And the United States just completely absent. So let's look at these dollar amounts that we're talking about here. The top fund here, the United Arab Emirates, has $627 billion in assets that they can invest. Now, how many ounces of silver? Let's do the math real quick, just for fun. Let's say that the United Arab Emirates decided that silver was the be-all and the end-all, and they're going to invest 10% of their money in that. So we're going to take $62 billion and I did one too many. So we'll take a zero off. Divided by the price of silver right now, and we'll use 33. So we're talking about, we need to take a zero off, we're talking about 2 billion ounces. That's just 10% of this Abu Dhabi Investment Authority. And you've got China, obviously, with nearly as much money. 10% of their funds going to be another 1 to 2 billion ounces of silver. You can see that even just 1% of all these funds added together would completely break this manipulated silver market. So it's very clear why they do the things they do. Now, ultimately, I don't think it's going to stand up. I think at some point you're going to have an Arab group like the Hunt brothers tried to team up with, or you're going to see a Chinese faction who's just going to simply come in at a price like this, or maybe where we are right now, and just plunk down maybe $50 billion and just say, you know what, I don't really care where the price goes from here. We're standing for delivery on the next month. You can take the price down to $8 if you want, but we're going to take delivery of this much silver. If they did that, if any of these groups did that, it is absolutely game over for these people that are running this gigantic paper Ponzi scheme. They are finished. They can't deliver 1% of that amount of silver, and they would be utterly destroyed. So that's why they play the games, and that's why you need to continue to stack, because ultimately this game of musical chairs is going to end. So as I wrap up here, I want to take you over to the Gainesville site, and I did a study on the Timberwolf. The question has come up again on the forum and on the blog about what silver to stack, whether you should stack bars, whether you want to stack junk. Now, I've tried to make it fairly clear that when I look at all of the potential scenarios, and of course none of us know the future, so the potential scenarios are inflation, hyperinflation, slow growth, steady growth, deflation, crash, collapse, dark ages. There's just so many potential scenarios out there. My best bet, with all of those things in mind, including counterfeiting, confidence, the ability to sell, recognizability, I have decided that the best investment for my money is going to be the semi-numismatic bullion coins that are just a bit above spot. Now, you can see our spot is about $33, and this moose is about $36. So you're paying about $3. If you go and look at your eagles and your other maples and things like that, you're really not going to be that far off. Here's your generic maple here. The eagle's not going to be that far from that. So you're talking about a difference of 70 cents. Now, if you've followed the Timberwolf, you know, well, let's pull that up real quick here. You know that for whatever reason, it may be numismatics, it may be just the popularity, the mintage. I haven't done a breakdown study of the mintage on these coins, but I can't find it on Gainesville. I can't find it in other places, but they have it here on APMEX, and you can see we're talking $69 for this Canadian Wolf series. So I'm definitely going to have to go with that Moose series. They also have it here, and the Cougar is another one that I picked. Got that Moose series here for $36.59, a little bit cheaper over at Gainesville. They still have an enormous number, and I just think that this is for $3.59 above spot. I really don't see how you can go wrong with this. I'm not remunerated, or whatever the term is, by APMEX or Gainesville or the RCM or any of these other people. I'm just sharing with you what I think is the best deal out there right now. That's what I've always done, and that's based on all the factors that I'm listing. So the key to this game that they're playing with the derivatives that are wagging the dog, this is the tail wagging the dog, is to buy on the dips. I don't think we have definitely hit that dip yet. We may actually get the correction, the ultimate correction, and if you really believe we're going to get that, the $22 correction, then you probably want to keep your powder dry and look for this $20 price target. I don't think we're going to get there. I don't think there's too many people out there who think we're going to get there. So if you don't agree with that, you might want to nibble a little bit, but we're definitely getting into a buying scenario where you're going to want to start thinking about what you can stack. And we'll talk to you next time.